Welcome to another Financial Fridays with Sainies and Equitable. Today's topic is all about the New York State pension, and Sainies is very excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. Joining us today from Equitable is Kelly DeMay. Thanks for being here, Kelly. And just a reminder, this session is being recorded. We'll save questions until the end of the presentation, but feel free to use the chat room or the Q&A at any time, and Kelly will get to them at the end. And a reminder that the Q&A is best used for general questions, but the Equitable team is available at any time to answer your personal questions. You can find contact information for your regional reps at sainies.org. And I will turn it over to you, Kelly.
Thanks, PH. So with that being said, today we're going to cover the New York State pension. So I'm going to go into both the macro and the micro of how the pension works, both on the front end from a contribution perspective and then at the back end when you go to retire. Thank you for dialing in on a day off for most of you. To give you all perspective, about a half an hour ago, I talked to one of my colleagues in Massachusetts, and they had a conference day today. So start off, I've got good news. Perspective is perspective, and most of you are off today. So that is always good. That's always good. So with that being said, to get started, okay, we're going to talk about pitfalls of your pension, things to maximize, timelines, what to pay attention to. We're going to go through the whole 9 yards, and we will be done in 28 minutes. I try to stick to the timeline we have. This is just saying that myself and my business partner, Luke, we are not tax advisors. So if you have specific tax questions, you can reach out to your tax advisor. But I am going to go through some tax basics as it relates to your pension today, just so that you are aware. So we're going to talk about the pension tiers. This is something that's getting a lot of press right now. I'm going to give you some perspective on that topic as well. We're going to talk about how to calculate your payout, the payout options, how the taxation on your pension works, and then how to supplement your pension in retirement, how to plan for that accordingly. Okay, so let's start with the tiering system. That's the first part of your pension, and that's where really everything begins. So Tier 3 started in 1976 and went through 1983. When Tier 3 occurred, the state at that time determined they took too many benefits away from state employees, and then they created Tier 4. Tier 4 is better than Tier 3. So sometimes people say to me, like, man, I just missed out on Tier 3. It's like, no. Tier 4 is better than Tier 3. Actually, if you were Tier 3, you get Tier 4 benefits because they are better than Tier 3 benefits. So really, anybody employed or starting to be employed from 1976 to 2009 are Tier 4 employees. Whether you're TRS or ERS, the systems or New York City, the systems all work the same. Then there was Tier 5 that was a very brief period of time that just went from January 1st, 2010 through March 31st of 2012. So that was a very narrow window. And then anybody employed in the New York State system after 2012 is a Tier 6 member. Now, there's a lot of noise out there about Tier 6 right now. You know, it's really bad and it's terrible. I got to tell you, Tier 6 is not as good as Tier 4 or Tier 5. Tier 6 is still better than the other 49 states have. So in my perspective, for what you contribute compared to what you get out, it's a really good deal. So grand scheme of things, I still look at it as a good deal. It's just not as good. So take that for what it is. So let's start with how's your pension benefit calculated? Okay, so first and foremost, once you identify what tier you are, your tier is when you enrolled in the system. It can also be when you started to contribute to the system. If you have time in another state, New York State does not have reciprocity with another state. So you might say, well, I started to work in Pennsylvania. It is irrelevant to the state of New York, so please keep that in mind. You cannot buy back that time. That does not matter. And then your payout depends on 3 criteria. What is your age at retirement? Your final average salary, which is the highest 3 consecutive years whenever they fell. It's technically the highest 36 consecutive months, not necessarily the last 3 years of the last 36 months, though often it ends up being that. And then how many total years of service or service credits? One school year is one service credit. Now, some of you are saying, well, I work 240 days contractually. 180 days is one service credit. In the event you work over 180 days in a school year, you do not get additional service credit above and beyond 180 days. You can get partial service credit. So let's say you were maybe not full time or didn't work a full school year, maybe because of a maternity leave or a leave of absence. You can get a partial service credit, but you cannot earn over a service credit. Anything above 180 days in a school year, you don't get additional credit for. One of the important components of service credits is that you get a break point based on your tier. What I mean by that is once you achieve certain years of service, you get a milestone, and New York State will give you an additional percentage for achieving that break point. We're going to talk about that more in a minute. Okay, so let's look at some examples. So if you're a Tier 4 member, there's two ways you can be eligible to retire without penalty. You can be 55 years of age and have 30 years of service. You must have both the age and the service credits with New York State. The age and the time. You know how there's those people who say, well, I'm going at 50. I wish I could retire at 40, but that is not how life works. You can't just dictate the time you want to retire. You got to play this by the state's rules. New York State has a really good deal in this pension, but the penalties you pay if you go early or you don't follow their rules are so significant that it makes it nearly impossible to retire early. Otherwise, everybody do it. So you've got to be 55 and have 30 years of service. You can have more than 30 years, but you can't have less. If you don't have the years of service, you've got to be at least 62 years of age and have 5 service credits. In the event you don't have 5 years of service, you don't get a pension. You need to have at least 5 service credits to earn a pension as any tier member. That's universal for all tiers. So as a Tier 4 member, you contribute 3% of your salary for the first 10 years in the system. Not 10 years worked, 10 years in the system. So let me give you an example. Let's say I was a substitute teacher at 19 years old when I was in college, and then maybe I left the state for a bunch of years and then came back at 28. But I entered into the system when I was a substitute teacher early on, and then it came back a number of years later. That started my clock. So I only maybe paid into the system for like a very brief period of time. That started my 10-year clock. And that's a good thing. What you contribute to that retirement system, either the teacher retirement system or the employee or local retirement system, that has no bearing on what you get out when you go to retire. When you go to retire, it's based on 2 factors. One is your number of SC or service credits. That's a term for how many years you've worked. And then the second factor is your final average salary. That's the highest 3 consecutively paid years whenever they fell. Okay, so let's look at those service credits and talk about the break points. As a Tier 4 member, the big break point is at 20 years of service. In the event someone works less than 20 years or 19 or less years, they get a 1.67% credit for every year they work. Once you get to 20 years of service, New York State says, okay, you've been a loyal employee for 20 years. We're going to give you a 2% credit for every year you work, retroactive to every year employed. So the difference between working 19 years and 20 years in the state of New York is you get about a 10% raise for 1 extra year worked. When was the last time you got a 10% raise? Like, this is a big deal. It's a big deal. And then once you get to your 30 years, you get that 2% all the way through. After 30 years, now New York State says, okay, you're expensive and we can hire somebody in the same role for less of pay than you do. After 30 years, they give you 1.5% credit for any additional year. That's not retroactive, because you're at the other end of your career and, you know, they're maybe looking to transition somebody at that stage of their career. So read that for how you want to. And then the final average salary is the highest three consecutively paid years averaged together. Now, a clause with the final average salary, and this can apply to administrators or where I see it most often. Listen to me on this. If you have more than a 10% increase on your final average salary from your salary in the year prior, that will change the final average salary formula to be the final 5 consecutively paid years. Let me give you an example. Let's say you were maybe a school administrator or school principal, and then maybe your last 3 years, you become like a district level employee, like maybe you become an assistant superintendent or superintendent, and you get a pretty significant bump in your salary. This is a common thing. That would impact your final average salary in the event you don't do that role for 5 years. They're going to take a larger span of your salary timeline from 3 years to 5 years to get more of an accurate picture of your salary. I'm not saying you should work 5 extra years or 2 extra years in my example. I'm just saying you should be aware of that. So just so you know, there's some different math we need to do with that. I just want to say that out loud because it can really impact administrators for the sake of awareness. Okay, let's look at an example. If somebody has 30 years of service, they're going to get a 2% credit because they have over 20. So 30 years times 2%, that would give you 60%. Let's say that final average salary is $100,000. 60% of that final average salary would be $60,000 a year, every year, guaranteed for the rest of someone's life. It's a great deal. Think about that. $60,000 a year, if somebody retires at 60 and lives till age 90, 30 years, it's $1.8 million the state of New York will pay out to somebody. And this person paid 3% of their salary for the first 10 years. They probably paid $12,000 total into the system to make $1.8 million. We call that ROI. That's a return on investment. That's a really good ROI. Now let's look at tier 6, the dreaded tier 6. Now, tier 6, you need to be 63 to retire. It doesn't matter how many years of service you have. You might have 40 years of service because you started at 23 and you got to work till 63. You would have 40 years of service. You have 40 years of service. Now, in corporate America, this is how, like, very rarely do people retire as early as 63. I'm not suggesting that anybody's job is harder or easier than another. But in just a perspective conversation, 63 is very common that people work that long in the grand scheme of life. Okay. So you got to be 63 in order to retire as a tier 6 member. As a tier 5 member, and I didn't go over tier 5 because there's so few tier 5 employees. Tier 5, you need to be 57 with 30 years of service to be eligible to retire. So it's actually a little bit in the middle. Tier 6, 63 with 5 service credits. As a tier 6 member, you contribute 3 to 6% for the duration of your career. How much you contribute depends on your income. The more money you make, the more you contribute. As administrators, given your income level, probably most you contribute on the 6% spectrum. The more you make, the more you put in. But it's going to be on a sliding scale. Once again, same factor or same formula, number of service credits and that final average salary. Same breakpoint. The breakpoint in tier 6 is 20 service credits, but instead of getting a 2% credit retroactive to the first year, it's 1.75. So changes a little bit. And instead of getting 60% of your final average salary at 30 service credits, you get 55%. And I could get into the weeds of the formula, how that works. And I'm going to do this quick, but it's 20 service credits times 1.75 is 35%. And then any year over 20 service credits, you get a 2% credit per year, but that's not retroactive. The 1.75% is retroactive. So 20 to 30 is 10 years. 10 times 2 is 20, plus the 35% gives you 55%. Now, I'm going to give you an example. Let's say you're my first person, you worked 40 years. You're going to get 75% of your final average salary. 75% of your final average salary. That's a big pension. So these people are going to have good, humongous pensions. They will get paid for their 40 years of service. Let's be clear. They'll contribute more for it, but they're going to get well paid for it. Just want to clarify. The final average salary is the highest 5 consecutively paid years. Couple of notes about this. In tier 4 and tier 5, extras count. If you coach extra sports, if you take on extra duties, if you do extra things, that counts in your final average salary. It doesn't in tier 6. It's just your baseline salary. Now, that doesn't apply really to administrators all that much, quite frankly. You don't have time to take on extra stuff. That's more so I find that on the teacher side of things, but I'm just saying that out loud for a reference point. So that's point number 1. The other thing I want to let you know, as a tier 5 member, the breakpoint's at 25 years. At 25 years, you get a 2% credit retroactive. So just a couple of nuanced little differences between each of these that you should be aware of in the event it applies to you. And this is why, I'm going to get on my soapbox here for a minute. Please do me a favor and do not talk to your best friend about what they're doing and use that as your financial advice. It's probably the biggest challenge and devil I fight every day is people come to me with a lot of assumptions and a lot of feelings and opinions because they hear a lot in maybe a lunchroom or they get a lot of opinions. And the reality is that all these little nuanced details are so specific to every individual person. Every person needs their own plan. So please keep that in mind. Do not follow the herd mentality of financial advice. Nobody else's finances are your own. Let's look at an example. Okay, 20 years of service is 35%. 20 times 1.75 is 35. Then for the additional 10 years, 20 to 30 is a 2% credit. So 35% plus 20% is 55% of $100,000 is $55,000 a year in that pension for that same 30 years of service. Now, it's only $5,000 less than my last example, but the ROI is less because of that contribution on the front end. Now, at the time of passing, the beneficiary will get that money on the contribution end. Food for thought. Okay, let's talk about payout options in our last 10 minutes. In my example, I've got Jane. Jane is 55. Her spouse is 50. Good for Jane. Jane's got 30 years of service and her final average salary is $100,000. When you go to collect your New York State pension, there's 11 different payout options. You can only pick one. The one you pick is irrevocable, regardless of circumstance, 30 days after your date of election and after your date of retirement. Once you commit to this, you can't change it, regardless of death, divorce, any change in situation. You must pick a natural beneficiary. It cannot be a non-natural beneficiary, meaning you can't pick a trust or something like that. It has to be human. So the first is the single life benefit that pays out for one single life. You get 100% of your pension, meaning Jane gets all $60,000. If Jane passes away, her beneficiary, her spouse, gets $0. The pro, Jane gets the most money. The con, nobody else continues that income pension benefit beyond Jane's passing. The next tranche of options are joint allowance options. Maybe Jane says, I can't afford to do that. My spouse doesn't have a pension. Okay, well, now Jane takes a reduction on that pension benefit to leave some or all of her pension behind. The more Jane wants to leave, the more it's going to cost. So if Jane wants to leave her full pension benefit behind, she now is going to get a pension benefit of $55,114 a year. If Jane passes away, her beneficiary gets the same full amount of $55,114 a year. The pro, Jane's beneficiary is going to get the exact same amount Jane got. The con, it costs Jane $5,000 a year, every year for the rest of Jane's life. Maybe Jane says, my beneficiary doesn't need that much. We've got some other assets, there's some other things going on, doesn't need that much. So maybe I'm going to leave half of my pension behind. Okay, you're going to leave less. So now Jane's pension is $57,453 a year. If Jane predeceases or passes away first, she's going to leave half of $57,453 behind to her beneficiary. Half of that amount is $28,726. So the pro is we're leaving half of that amount, half of 57,000, which is 28,000 to the beneficiary. The con is it still cost a reduction between the 60 and the 57 of $2,500 a year. The 75 and the 25% work exactly the same way. You can leave 75% of the 56,000 or 25% of the 58,000. Then we have the 5 and 10 year period certain. These are the two oldest options. These were the original options. This is if you know you're going to pass away in 5 or 10 years. I only see these elections picked if somebody is terminally ill and knows they're going to pass away. I've had circumstances where I've had clients be aware of their health situation, unfortunately. So this is a very unique circumstance. I probably would not advise somebody choose these unless there's a highly sensitive situation. Now let's talk about the pop-up joint allowances. Very popular. So let's say somebody says, okay, now I want to take the pop-up joint allow full. All right, so in this example, Jane now, she's going to get $54,856 a year. If she passes away, her beneficiary gets the full amount, $54,856. But what if the beneficiary predeceases Jane? Well, in that example, if the beneficiary passes first, Jane will pop up to her single life benefit of $60,000. So if we compare the joint allow full and the pop-up, you're going to notice the pop-up costs a little bit more. Jane's going to get a couple $100 a year less in that pop-up option because she's getting a better benefit because she's going to pop up in the event that the beneficiary passes away first because you don't know what could happen. So there's some extra insurance there, if you will. It's going to cost a little bit more. So that's the benefit, and that's why it costs a little bit more. The pop-up 75%. Okay. Now Jane gets 56,058 a year. In the event that Jane passes away first, the beneficiary gets 75% of that, or $42,000 a year. If the beneficiary predeceases Jane, Jane pops up to 60 grand a year, so on and so forth. You got one chance to make this decision. How you make the decision, I would strongly recommend you do a financial plan to determine what the best option is. I often have people say, oh, we're going to take the single life, we're going to take the pop-up. Unless you've really ran the numbers, I just don't know that I would just wing it. You just never know what could happen. Let's talk about taxes. How will my pension be taxed? Your pension is not subject to New York State tax. It is subject to federal tax. In the event you are going to work part-time in retirement, maybe you're going to do interim work, what have you, you might want to be aware of your tax withholding on your pension because I often find that when people retire initially, they do not have enough tax withholding on their New York State pension. Think about it. When you go to retire, New York State doesn't, the New York State pension system, when you go to elect your withholdings, they don't know you're going to go be an interim or go back to work part-time. So they don't know you have this additional income. They don't know you're also collecting maybe Social Security. They don't know your spouse's income. So just be aware of that. You're going to need to pay attention to that. You're going to need to work with your financial advisor on that, or your CPA and tax preparer. That is a common challenge that comes up is not enough federal tax withholding. Also, if you move to a state that has state taxes, you will pay that state taxes on your state pension. So if you move to Massachusetts has Massachusetts state tax on your New York State pension. You will not pay New York State tax on your New York State pension. Okay, lastly, how does this all work together? So first and foremost, you've got your New York State pension. Now you're going to see I draw this as a flat line because there is not a cost of living adjustment. There is, but it's really teeny tiny. That pension doesn't keep pace with inflation. And if you think about it, if somebody retired even 10 years ago, things cost a lot more now than they did. So that pension isn't going to keep pace with inflation. You're going to collect Social Security on top of that. Social Security will keep pace with inflation. Your retirement expenses are going to go up because goods go up. You all go to the grocery store. Things cost more and more every single day. You all go to the gas pump right now. Things cost more every single day. So expenses go up, and that's where your supplemental retirement accounts are going to come in and help fill the gap. It's not a matter of if you're going to need them. It is a matter of when you are going to need them. Pure and simple. So that is how everything is going to play together and should. There are two big mistakes I see people make. People become too conservative in their retirement accounts too early, and people take large withdrawals early on in retirement. Those are the two kiss of death elements when it comes to retirement planning. Food for thought. So, with that being said, if you need help with this, by all means, please feel free to reach out to me. You can always reach out to me directly at kelly.demay@equitable.com or Saney's members at equitable.com. That will also come to me directly. By all means, please always feel free to use me as a resource. And with that, I hope you all have either a lovely Easter or Passover, whatever you celebrate. Certainly, if you need anything or I could do anything, please don't hesitate to reach out.